Hello, everyone. Today, we are going to have an AMA with Term Finance, co-founder, one of the founders and CEO, Dion. Nice meeting you, Dion.
Hey, it's great to meet you. Thanks for having me on the show.
Yeah, so we are happy to be a part of your Korean market expansion plan and also would love to introduce Term Finance to all the Korean users and institutions, like whoever interested in such an amazing DeFi platform. So before we start, would you please briefly introduce yourself?
Sure. So I'm Dion Chu, CEO and co-founder of Term Finance. My background is actually from traditional finance. Started my career at a hedge fund in New York City called D.E. Shaw. Was interested in public policy, so joined the Federal Reserve Board of Governors in Washington, D.C. from '07 to '09. So bracketing the financial crisis. It's a 2-year program. And given my exposure to Washington, decided to get a law degree. Graduated from Harvard Law in 2012. Realized I didn't want to practice law, so came back to New York and started a career trading U.S. government bonds, first on the sell side and then on the buy side, and ultimately decided to leave to start a small family office. And in that process, discovered DeFi. So back at the time, TradFi rates were zero, DeFi rates were double digits, so super interesting. And as part of that journey, started to advise various crypto projects. And one of those projects actually served as a DAO treasury manager. And it was in that role, managing short-term liquidity for a DAO, that I started to realize a gap in the DeFi lending ecosystem. So at the time, all the lending protocols were floating rates. There wasn't any way to fix an interest rate, so you have certainty as a lender. But also as a borrower, you're always subject to constantly fluctuating borrow costs. You have no idea what you would end up paying. So coming from a fixed income background in TradFi, saw this as a big opportunity to try to build something like this in the DeFi ecosystem.
That's an interesting motivation and awesome background. So we have seen a lot of people from the Web2 side, especially from finance, moving on to Web3 and also building a new platform. I see that Term Finance would be one of the similar kind of platform, but it has special features. So prior to explain more details about Term Finance provides, would you please give a one sentence short description about what Term Finance is?
Yeah, so very simply, Term Finance is a lending protocol that offers fixed rates for a fixed period of time. So in all other ways, it's very much the same as Aave and Compound. All loans are over-collateralized by ERC20 tokens.
That's very interesting. So we have a lot of keywords here. So let's dig down more. So I'm sure that you have faced a lot of problems that you think it has to be fixed in Web2 and Web3 as well, based on your career. What problems specifically does the Term Finance target and try to solve here?
Yeah, here specifically, I think from the DeFi perspective is offering fixed interest rates. So as I mentioned before, DeFi interest rates are very volatile. So just 2 weeks ago, you're earning 10% on Aave. Today, you're earning 6%. 2 weeks from now, it's anybody's guess. It's very hard to really commit to lending in DeFi when you have no idea what interest rate you're going to earn. You come in, you think it's a really good rate, and then 2 weeks later it disappears. So we want to solve that for the lenders. On the borrow side, a lot of times when you borrow money, you want to have an idea of how much you're going to owe. And with DeFi lending, you really just have no idea. And what you see on the floating rate protocols, when there's a lot of borrow demand, you see interest rates range from 5% to 50%, each hour constantly fluctuating. It's extremely uncomfortable to be a DeFi borrower during those times. Coming from a TradFi perspective, what is unique about the blockchain is that you can have truly trustless lending. So I don't know if you remember, but a couple of years ago, a lot of people were lending and borrowing on Genesis. And because Genesis was insolvent, a lot of those users had their money locked up for multiple years, and ultimately they didn't get full recovery. And that's because when you lend through a centralized intermediary, you take the risk that the centralized intermediary goes bankrupt and doesn't have the funds to pay you back. With a fully decentralized lending protocol, like Aave, you saw that there was no bad debt, even during the worst market downturn. So really that's trying to leverage the best of DeFi, but offering the stability that you have in TradFi with the fixed rates.
Yeah, you're correct. I remember the date when FTX collapsed and all this bank run and bankruptcy happened, especially from those people who claim themselves as a DeFi, but on behalf of it, apparently they were actually more like a CeFi platforms, and all the monies were settled and in the centralized storage or vault like a system. That's very interesting. So I see that like you already gave more like a lot of ideas. So other than lockup, those like transparency on chain, what are some of the big differences between Web2 and Web3 finances?
Yeah, I think in terms of the financial theory, it's kind of the same. Good and sound financial theory is the same regardless of what technology you're using. That's mitigating counterparty risk, mitigating market risk. All of those things are the same in both Web2 and Web3. I think the key difference of Web3, or I think there are two. The first thing is DeFi or Web3 is open to everyone. And a lot of that is possible because Web3 is able to do a lot of Web2 things at a fraction of the cost. So you think about back when I was at a large bank, you have hundreds of back office administrators whose job was to process paperwork, send confirmations through email, through fax. And all of this stuff can happen on chain, atopically, in a single blockchain at a very low cost. So because of that, with DeFi, you can open it up to the entire world. Whereas in a large centralized bank, you're only going to service large clients because it's just too expensive to onboard anybody who does very small volumes. So I think the first piece is the open access that DeFi offers.
So is that also one of the reasons why you decided to leave the big corporations from the Web2 finance or Web2 world and moving on to Web3?
Yeah, I think TradFi is a great place to learn about finance, financial theory, to get a very good solid grounding in modern finance. But TradFi, at least in America on Wall Street, is kind of already at the peak. Some might even say it's starting to decline after the financial crisis. So working in an industry where there's no growth, really what happens is everybody's just trying to fight for their piece of a fixed pie. What's exciting about DeFi is that it's just starting. There's so much to build. There's so much to grow. Everybody can win at the same time. And I think that kind of fits in with the Web3 ethos is that, it is so new. So the industry grows, everybody does well together. And so that's just a lot more exciting. There's a lot more room for innovation and growth.
Interesting. So I think like that's why a lot of Web3 companies are hiring more from like a big corporations from Web2 or especially Web2 finance if they are building a financial platform. I also know that Term Finance has a lot of individuals with such a great careers and backgrounds from the Web2 side. Can you also explain about like what's the team consistency and like how does it help? And also like what do you think like those kind of experience or backgrounds from the Web2 side are helping to grow and build a better Web3 platform from your point of view?
Yeah, no, I think, you're totally right. In Web3, there's been a lot of growth and maturity in terms of the teams that are starting to build on the blockchain. Early days, there's a lot of enthusiasts, a lot of kids in college just playing around with Ethereum, with Solidity. It's kind of an experiment. And, some really cool things came out of that. But also what happened was that you also saw a lot of DeFi protocols make simple mistakes that already happened in TradFi. So it's like all the mistakes DeFi made, people made in DeFi in a span of just 2 years. And so, over time, you see a lot more people coming from the TradFi space, like myself. A lot of the projects I advise, I'm just like, okay, yeah, you can't do that. But obviously, if you don't have that background, it's not very hard to learn. You just need the experience and have seen it before, and you know what is going to be work and what is not going to work, what's not safe. So yeah, I think from our side, our team on the business side, we have 3, all from traditional finance background. I already introduced myself. One of our co-founders, Billy. He built a lot of exchanges in the past. He built carbon markets. He also built interest rate benchmarks in the U.S. that regional banks in the U.S. use to price their own loan books. Another co-founder, Di. He started his career at Citibank, to Morgan Stanley, and then was a structured products trader at Golden Tree. So we all come with deep financial background, all united by this interest in DeFi and crypto. And that's sort of how we came together. And then on the technical side, we have technical co-founders from Amazon's blockchain group, worked on Planet Labs, the big satellite imagery company. And so from the Web2 technology side, we're able to bring in talent that has built large scale products. And I think that's really important because in DeFi now, like it really is, you really have to handle the kind of volumes and handle it with the kind of maturity that, and professionalism that you learn coming from a large tech company in the US.
That's very good. So from your point of view, also you have a lot of like extended experience and like a bunch of people on your team that can also do some innovative works through term finance. I would like to ask you about like how do you find an application of those like Web2 experience or strengths in the traditional side to be applied to Web3 through term finance? And also, what are some like core difference between other platforms like Aave or Compound who are already providing similar products to the users fully on chain?
Yeah, I think, a lot of it comes from the product side. So, when designing the product, figuring out how the liquidations are going to work, what is the liquidation mechanism, what are the constraints around the liquidation, how does the auction mechanism work, what's the most efficient way to create a market, what do you want to optimize for, what are things you must avoid, all the product design, that comes from the experience of having done this before and seeing and knowing firsthand as a trader, what people actually need and want. And so I think that experience really comes into product design. And what people want from a financial instrument really is the same regardless of whether it's Web 2 or Web 3. You want efficiency, you want ease of operations, and you want risk controls. And so that's kind of universal. It really doesn't matter Web 2 or Web 3.
Listening to your answers, it seems like Tom Finance team has a lot of high potentials, but also it looks like a team of veterans can do everything in the very different angles. But also I'd like to highlight the technical specs that your team has. So one of the things that Term Finance is highlighting here is basically the fixed rates and also the fixed term loan and auction options. I would like to mention like regardless of like financial reasons why fixed term and fixed rates might be better than some flexible terms and flexible rates. Do you also have any other like specific highlights in terms of tech side so that you can share with more of our audience?
Yeah, you did ask, what are some other key differences between term and floating rate protocol like Aave and Compound? So the way Aave and Compound work is people deposit, their stable coins onto Aave or Compound, and then borrowers come and take that liquidity. They have to cap the amount that borrowers can take. If they take away all the liquidity, then the lender doesn't have the ability to withdraw their capital when they want it because the money's not there anymore. So the way that they prevent that is they set a cap. They say at 90%, if borrowers take out any more than 90%, then the rate's going to shoot up to 50, 60%. So it's a penalty to encourage borrowers to repay or encourage lenders to put more capital in. The downside of that is then during that period when it's above 90% utilization, the interest rate is extremely volatile. It's constantly jumping from 5 to 50, 5 to 50 as depositors and withdrawals are constantly coming in and out. So that leads to extremely volatile market. On the other hand, the partial utilization model also hurts the lenders. That means at most times, at most 90% of your funds are being utilized. 10% is generating zero income. So if the borrower pays 10%, the lender earns only 9%. And when utilization is low, right now, Aave utilization is only 60, 70%. That means there's 30% that's idle generating zero revenue. So capital efficiency, this is something you want in DeFi and TradFi. And this is not a very capital efficient model when only 60 cents of every dollar you deposit is generating any revenue. Term doesn't have this problem. The way that we match the market is we do direct matching through the auction. So we have 100% utilization always. If there's any unutilized capital, it's automatically returned to the user. So what that means is that the lender now is earning the same rate that the borrower is paying. So because we don't have to hold on to this excess margin, all the lenders are able to earn more than what they would earn on Aave or Compound, even though the borrowers are paying the same interest rate. So we're able to return a lot of that value to the lenders.
I think that's also connected to the advanced model of this like lending and borrowing protocols. And also I feel like it's one of the reasons why Term Finance brought this new concept called auctions for the lending protocol. And there's apparently there's a product called Term Auctions on Term Finance. Can you explain a little bit about like term auctions and also like how does it determine this like optional rates and terms compared to this like traditional ways of on-chain lending protocols?
Sure. So, I can't claim credit for the auction. Auctions have actually been around for, over 1,000 years, been around for a very long time. This specific type of auction is used by the US government for issuing US government bonds. Every G7 country also issues government bonds through a similar process. Anytime you need to sell a large volume of some financial instrument, an auction is a very good way to do that. First reason is because it's a coordination mechanism. You announce the date of the auction, everybody knows when it's happening, so they can come together at a certain time and then be able to take down the supply in an orderly fashion. If you try to dump all of that into the secondary markets and you only have market makers that don't have enough capital to handle that kind of balance sheet, then you get markets that are very volatile. So auctions have been used and are still used to originate large volumes of debt in the first instance. A lot of people don't know this, but the New York Stock Exchange in the morning, 9:30 a.m., also holds similar, they call it a call auction, where everybody puts in the price they want to buy for the stock, and then at 9:30 they clear the market at a single price where the buyers' supply and demand, clears. And also for the first 100 or so years of New York Stock Exchanges, they only had auctions. It was just every day at 3 p.m. They held one auction for every stock on the exchange, and then no trading. So over time, markets developed into continuous order books. That's what we see now. And that works when you have high volume, high volatility assets. For something like fixed rate loans, this is not a high volume, high volatility asset. So trying to maintain an order book at all times, you just don't have that critical mass. And so, we decided to go with auctions because it's the perfect fit for a market like fixed rate loans. The way the auctions work, they are what we call single price, sealed bid auctions. And I'll go through each term to explain. Single price means that everybody who participates and succeeds in the auction receives and pays the same interest rate. So there's no price discrimination for some people pay higher, some people pay low. No, everybody pays the same rate. The sealed bid side means that these are blind auctions. So when you submit the interest rate that you're willing to lend or the interest rate you're willing to borrow, this is hidden from the public. So what that means is, one, as a lender or borrower, you're never going to do worse than the interest rate that you submit. You can only do better. And because it's hidden, most of the time, you'll likely end up doing better than the rate that you submitted into the auction. So that means you're going to tell the truth. There's no penalty for telling me your true value. And as long as you're willing to lend up to a certain value, there's no reason to report any value less than that, because you're just giving up an opportunity to do something you'd be happy to do. So yeah, that's the value of doing the blind auction. And so once an auction closes, you have all of the lenders, all their rates, you have all the borrowers and all their rates, and then you can create a supply and demand curve. And then you just run an algorithm to find which price maximizes the volume matched, where the condition is anybody willing to receive the clearing rate or less receives a loan. Anyone willing to pay the clearing rate or higher, is able to borrow. And based on that, you can determine the optimal clearing price. And that's what the smart contracts are doing in the background.
Wow, that's a full of like deep concept of the finance and also technology. But what I understood about is basically the auctions are way more efficient to bring up like more advanced way of, it could be regarded as a competition, but it could be also regarded as a giving a like a better way so that they can communicate on top of like a full transparency. And also I would say like maybe more like a justified way of doing the deal communications between like two counterparts. Here I also have another questions regarding the full process, that it always requires a liquidity so that every deal flow and like all the communications between lenders and borrowers to go smoothly. And that's also one of the biggest problems that this Web3 industry itself is facing at this moment. So how do you solve this? We found out that there's a term called over collateralizations on ERC20. Can you a little bit explain more about it?
Yeah, so over collateralization in general, what that means is when you make a loan, how do you know that the borrower is going to repay you? Right? In DeFi, you don't know their name, you don't know where they live, you don't know what country they live in, you don't have their phone number, their address, or email. There's no legal agreement. So the way that you guarantee that they're going to repay you is that they have to put up collateral. So people might be familiar with a mortgage. When you buy a house, you can borrow money, but now the bank owns your house. They hold on to your house title. So if you don't pay your mortgage, then the bank can take your home away. And that's how they know that even if you don't pay, they're going to get their money back. So this is the same idea. Instead of a house, you're putting, collateral like Bitcoin or ETH. So that's the concept. And when you buy a house, typically, at least in the States, you have to put down 20% and the bank will lend you 80%, right? So you flip that around. What that means is if you have a $1 million house, you can only borrow 800,000. And that difference, the extra 200K over and above 800,000 is 125% over collateralization. So that means you have a $1 million house backing an $800,000 loan. The ratio 1 divided by 0.8 is 1.25. So that's over collateralization. So even if the price of the house falls below the market price, as long as it falls less than 20%, the bank can still get full recovery of their $800,000 loan. So that's the value of over collateralization. If they lent you the full $1 million and the price of your home falls even by a little bit, now they're losing money. They can't get that difference back. So that's why it's important to make sure you are over collateralized to cover any movements in the price of the collateral. With crypto, it's the same process on term, on Aave, on compound. Typically for something like Bitcoin, very liquid, you can trade millions of dollars with very little slippage. The market looks for around 125% over collateralization. So similar to a mortgage. Difference between a mortgage and Bitcoin is a house takes a long time to sell. Bitcoin, you can sell millions in a matter of seconds on chain, with no price impact. And so, that's the basic concept behind over collateralization.
Interesting. So this over collateralizations, how does it correlate with services on the term finance?
Yeah, so all loans on term are also over collateralized. What's unique about term and different from Aave is that on term, you only lend against one collateral type that you know ahead of time. On Aave, you lend against every collateral on Aave. So you don't have a choice. You either lend against all of it or none of it. So there might be some collateral tokens on Aave you're not comfortable with, but you really don't have an option. On term, you can pick and choose. So you can say, I only want to lend against Bitcoin, or I only want to lend against ETH. Every loan has its own isolated, segregated smart contract for holding the collateral. So there's no commingling, no mixing of collateral between different loans.
So it can also mean that you might require users deposit or stake or put as a collateral into a certain type of asset class, like let's say BTC only, Ethereum only, like this kind of like a big asset classes, so that you can retain this over collateralization model. Does it also relate to your vault system as well?
Yeah, so we can kind of talk about the different products. So far, we've been talking about the auction. The auction model, I'd say, is the advanced model. These are primarily institutions, whales, DeFi hedge funds that do DeFi farming as a day job. So for them, coming once a week to do an auction is not a lot of work. We also have a lot of users, they have other jobs. Maybe they're a doctor, maybe they're a scientist. They don't have time to monitor these auctions every single week. It just doesn't fit into their schedule. So we created 2 new products to help serve those users. The first product is, we call it the Blue Sheets Earn page. Here you'll see a list of different lending opportunities at a fixed rate, the fixed maturity date, and you can come and lend at any time. You don't have to come at a specific time of the week where the auction is happening. And what really is going on underneath the hood there is that somebody who lent in an auction, they take those fixed rate tokens and they list them for sale through the Blue Sheets product. So now users can come, they can see the collateral, they can see the collateral ratio, how much over collateralization there is, they can see what the interest rate is, it's fixed. They can come and lock in that fixed rate. And then once the loan is repaid, the lender will come back and redeem for their principal plus interest. Now, for some people, that is too much work, because you have to remember to get your money back, put it into something new, and you have to choose which loans you want to do, which loans you don't want to do. So for people who don't even want to do that, we have a new product called the Vaults product. Vaults product is built on Yearn v3, and it's a vault that automates the entire process for the end user. So we have well-regarded risk curators from like MEV, RE7, all these large curators who also do risk curation on other protocols, also curating the vaults. So there, all you have to do is deposit into the vault, and the curator will handle submitting loans into the auctions. The vault will automate the redeeming of loans, the reinvestment of loans, so that all a user has to do is deposit and sit back. From a gas perspective, it's also much more efficient. The curators cover all of the gas costs for the operations, so the only gas cost that needs to be paid is for the single deposit transaction. So I would say those are kind of the 3 layers or entry points into term. And so really encourage users to kind of figure out where do they fit? Are they advanced, intermediate, or entry level? And choose or select their product based on that. But yeah, for the vaults, all the vaults are very clear about what collateral is acceptable into the vaults, as well as the minimum collateral ratio for each collateral type. And through that, they can choose which vaults they are comfortable with. If they see collateral they don't like, maybe you don't deposit into that vault.
So that's very interesting. We have talked about a lot about like the deep technology and like financial systems, but let's move on to more like easy and simple things that maybe people want to hear more about, which is about the yields, like how can they farm tokens, or like how the system works for those like new users into Web3 or DeFi. So like you have explained so far, term auctions and term vaults, which are all like great products provided by Term Finance and provides different types and with a different target. So let's say like if a user would love to farm, let's say points or like just a simple token farming kind of thing or yield generating, what is the products that you provide in order among these 3 services? And also, what are some of the expected APIs that people can expect from just simply put their stable coins into any of these services?
Sure. So in terms of the points rubric, auctions will earn the most points because auctions are the most work. So holding a loan earns 1 point per day for every dollar lent through Term Finance. If you participate in an auction, you will get an additional 1 point per day for every loan or tender submitted through the auction that gets filled. So a successful offer in an auction. There are additional multipliers. So if users participate in auction every single week through multiple different types of markets on term, then they can earn additional multipliers through the auction points. So that all of that is really to encourage really active, sophisticated players who put in a lot of time to help make term work. Blue Sheets as a lending is basically lending through term, and that earns just a standard 1 point per dollar per day, as long as you're holding those tokens. And then with Term Vaults, it's our newest product. We really want to help grow that product. So we're currently offering 1.5 points per dollar per day for any tokens deposited into the Vaults product. In terms of the native yields, it does fluctuate some, but it will fluctuate less than Aave and Compound. So for example, a couple of weeks ago, early market rates were around 12%. The vaults were able to lock in 12% rates for 4 weeks. So even though some of the yields have come down over the past week or two, and the new loans are around 8 or 9%, still have significant funds in the vaults earning the original 12% fixed from the prior 2 weeks. So we're able to get higher rates. And again, as I mentioned before, we don't have the utilization, the loss due to lower utilization, partial utilization. So, your vaults are still earning around 10% native yield. In terms of the points, I think that's really up to the market to speculate. But, a lot of people on Twitter have different calculations and estimates there. I can't vouch for any of them, but they're available if you guys want to take a look.
Sure. I think that will be like one of the most interesting, attractive points to the users that like you guys have a great backers, great team members, great products. So people might want to do more of the token farming, also the point farming. So it's basically like a dual farming system in terms of the tokens that they deposit or like put it in the services. Also, they can expect the points in the future. I think this is amazing.
A lot of our loans lend against collateral like EtherFi, LSTs, Athena, and a lot of these protocols are offering additional incentives and points to the lenders on term as well. In some cases, you can earn both term points and partner protocol points. And if you follow the website, you'll see little icons that indicate when that's available.
Wow, that's great. So I was going to ask some similar questions to that, asking how many asset classes does the Term Finance provide or support? And also, what are some additional protocols that people can expect double or triple or more points farming or like the token farming system?
Yeah, so obviously it's super important that borrowers on term, when they move their collateral to term, that they don't lose their points because it's still technically the borrower's tokens. So with every protocol that we list, our partner protocols continue to track the collateral holdings and assign points to the borrower side. Some of them also offer additional incentives to the lenders on term as well. So LSTs like either Phi and Renzo are all offering additional points to the lending side. DUSD from the Elixir team is also offering additional points to lenders on term. Treehouse ETH is another one, and Lombard Bitcoin, so LBTC. So anytime you lend against those collateral, you'll be earning through the blue sheets or through an auction, then you'll be collecting those partner protocol points as well.
That's amazing. So I see like people now have to hurry up to join and see more options for their preferences. That's really interesting. And in terms of stablecoins, do you also support both USDT and USDC, or do you support any other like further stablecoins coming out of different protocols?
Yeah, so our protocol can handle any ERC20. There's only two requirements. One, that there is an oracle that we trust, and two, there must be on-chain liquidity. So if you take collateral, if you take as collateral a token that has no liquidity, then you can't recover funds for the lender. So we want to make sure there's always enough liquidity to sell so that the lender can be repaid. But as long as those two conditions are true, any ERC token can be onboarded under term, and it can be onboarded very quickly. We've been doing USDC primarily because that's what our users want. But if we had users one day say, I want USDT instead, then we could easily do USDT as well.
There's also a high potential when there's a new stablecoin. I know that some big foundations are working on their own stablecoins due to like resolving their regulation issues. So I see that like more liquidity coming to the market means that more potential users available for term finance to provide this like amazing services to them, right?
Yeah, absolutely. Stable coins, RWAs, if you have more and more yield-bearing RWAs come on chain, it'd be great if you can borrow against that collateral and do some looping or something like that.
Interesting. So moving on, I'd like to also ask some questions as of a new user to the whole blockchain and crypto finance market. So everything is now decentralized means that everything is going through on-chain activities. And on-chain is basically somewhat vulnerable and like 100%, 24/7 exposed to the digital market, means like hacking issues, like security issues, or like server stability issues, like all these like different issues are surrounding these on-chain platforms. And that's probably one of the things that new users who have never been in this like crypto trading environment always thinks about it. So what are some of the like characteristics or features that you can also explain to these people on behalf of term finance? And also, what are some of the things that you are facing as the hardest challenge in terms of on-chain, and how term finance is solving it?
Sure. So if you're new to DeFi and you're trying to understand the security, smart contract risks, I think the first thing is make sure that there are very good audits. A lot of the hacks come from just simple coding bugs. Right? In Web 2, you make a mistake, you catch it, you fix it. It's very easy to fix on the fly. On the blockchain, it's more like building a plane. You have to get it right the first time, or it falls out of the sky. So, and it's very expensive to do these audits. So you really have to do a lot of testing beforehand to capture all the bugs. So the first thing is just make sure there's no logic errors. It sounds very simple, but in coding, it's very easy to introduce logic errors if we weren't careful. And so that comes from a lot of testings. On term, we did 3 months of testnet testing, additional 2 months in private beta to make sure you catch kind of all the basic operations. And you try to catch all of the edge cases. You want to map out the different paths that the user flow can go through to see if there's some corner case that you didn't contemplate that might lead to something unintended. So that's the first thing. And a lot of audits help to cover that. But even better than audits is formal verification. So what formal verification is, for people who aren't familiar, it's essentially a programmatic way to test all of the potential possibilities and paths across all the interactions in your smart contracts and ensure that they follow certain basic rules or invariants, which are expectations of how the system should behave. It takes a lot of time to do this. Some projects do a very shallow job. Some projects go very deep. For us, we had over 250 rules that we tested against all of our smart contracts to ensure that it was very thorough and captured every single potential issue on term. We've also done multiple audits through term, but really the real test is the test of time. So you have enough capital in your protocol, it's going to be worthwhile for somebody to try to hack it. And the longer you've been around and not been hacked, the more confident you are that really is no bug. So, audits are great, formal verification very necessary, and that's to prevent any dumb mistakes in the early days. And then once you pass that period, then it really is about just a test of time. So, we're happy to say that we have never been hacked, have zero exploits, and we hope to keep it that way. One thing that really de-risks Term relative to the other protocols, it's a pro and a con. People in DeFi love instant gratification, the ability to come in and out, borrow, lend whenever they want to. But that's very expensive. We already talked about utilization. That means that it has to be idle capital, so it's not capital efficient. And two, that introduce large vectors for attack, because now people can come in and borrow and lend anytime and try to exploit any errors in the code. With Term, the only way to create a new loan is through the auction process. Once the auction closed, there's no way to create a new borrow. And for most of the lending protocols, a lot of the hacks come from doing flash loans and exploiting these protocols that have, on-demand, instant interactions. And so because of the way we're designed, that entire vector of attack has been closed. So, there's just a much lower attack surface through these discrete weekly auctions. Another key thing is access controls. So there's certain admin functions for every protocol that must be gated. And the question is, how do you gate those functions and methods? And, how do you secure those wallets that have access to those important functions? So Term, we have a full page on our access controls. We show, which multi-sigs can do which actions on Term, who all of the signers are visible on chain. And we have an attestation from DeFi Safety showing that they've validated and audited that every signer is a different person. Right? Because it's very easy for me to say there's 7 signers, but all 7 signers are me. Right? That's not very secure. So you do want somebody to verify that all of these signers are indeed separate individuals. And so, we have policies around that. It's very formalized. We've gone through proofs to show that is indeed, we are doing what we are saying we're doing. And the third piece is monitoring. So all of the important functions that we mentioned, we monitor in real time. If any of those functions are called, it creates an alert on Slack. So if you start seeing an alert that you don't know about, then there might be a problem, and it tells you to immediately go and investigate. So I think those 3 items are the key smart contract on-chain security features that every protocol really needs to spend a lot of time focusing on. And beyond all that, then you have all the other Web 2 stuff. So, the Web 2 infrastructure is typically lower risk because all of the important stuff is secured on the blockchain. So Web 2 is mostly around services, around the interface, the UI, the website, supporting all of those things. But it's still important because if somebody hacks the UI, they can redirect the deposit button to deposit into a fake contract, stuff like that. So it's also still important to focus on the Web 2 security through best practices carried over from the Web 2 side.
So it sounds like you have the full aspects of the security and also like all storage, our own chain platforms, like even internally, like you are covering all this like potential places where hackers, where cyber attacks can happen, fully covered by. Well, another question regarding your answer is, do you also work with external parties to support or strengthen the security features as well?
External parties.
Like Term Finance is audited by some trusted agencies or institutes.
So yeah, for our audits, we've used Sigma Prime. Sigma Prime, has been around for a long time. They've audited all of the big major protocols. They're a big auditor for Aave as well. So they are our primary auditor, and they've looked at all of our primary protocol contracts. We've also worked with companies like DDoB, Runtime Verification. We actually found a really great team out of Korea, actually, a team called Chainlight. And I found out about them because they win all of the coding competitions. So I'm like, all right, if these guys are good at coding competitions, then they must be really good at auditing. And those guys are super sharp. So, we use a range of auditors, but we really just focus on the best quality. With our formal verification, we worked with Certora. Certora is the leading blockchain company for formal verification of smart contracts and Solidity. So that's who we worked with on that side. And of course, we worked with DeFi Safety to do a lot of the auditing. And we actually offer, Nexus Mutual actually offers insurance on Term as well, because they've gone through all of our audits in the formal verification. And users can purchase insurance from Nexus Mutual at a rate similar to the rate on Aave.
So the reason why I ask you these questions, especially the yield side and also security, is because those two are the priorities of the Korean users when they review any kind of like DeFi platforms. As you know, there has been like the largest issue incidents in the crypto industry, which is, Terra Luna.
Of course,
Since then, a lot of people paying attention to security and yields. So even though if the yield is too low, then people are gonna, oh no, I'm not gonna use it. But if yields are too high, they also gonna say, oh, is it scam? Like we haven't experienced with that. Also, they look into security like, oh, is it like centralized or decentralized? Or is it like a fake decentralized kind of thing? Like it's not about like they trust either centralized or decentralized, but they always look into this kind of details. It's a good growth in terms of the knowledge growing up, more people paying attention into some core concepts and ideas in the crypto industry, but also somewhat sense like people need to know more information and platforms are entitled to provide these informations as well. So how does the term finance prioritize these two values that Korean users paying attention? And are you also working with any other Korean companies? Because this is another part that people paying attention into the trust level of the platform, especially coming out of Korea.
Yeah, absolutely. I mean, honestly, those are the same two priorities we have as well. Especially coming from a fixed income background. The stereotype on Wall Street is the stock traders are very risk forward, and then the bond traders are, defensive and conservative. And we take a very similar approach. Any new collateral token that we onboard on a term, we read all of the smart contracts. We make sure everything does exactly what it says it does. We look at the audits, make sure the oracles are safe, and then we, make sure that we set very conservative over collateralization numbers so that even if there is a DPEG, lenders are going to be safe. So, throughout our history up to now, knock on wood, we've never had any bad debt through our protocol. So safety and priority and risk is our number one concern. The yield side, if you want high security, low risk, then yields have to be lower, right? So ultimately, the yield on the collateral is typically going to be higher than the yield on term. Look at Athena, SUSDE, you have rates ranging from 10 to 20%. But on term, if you lend against that token, typically you'll have 110, 120 cents for every dollar that you lend against that. So you have much lower risk as a lender than you do holding the underlying collateral outright. Because of that, you're going to earn slightly lower rates for that extra security. So term is not always going to have the highest interest rates, but it will have much lower risk than holding the underlying collateral. And that's just the nature of all lending protocols, right? It's always going to be lower risk, lower yield. But yeah, in terms of our ethos, it's really number one, do not let the lenders lose money and try to find the best yields available subject to protecting capital. And that's always been the fixed income mindset is preserve capital. It's not the best for, Degens want to make 10x. And so, our user base tends to be more institutional, right? Larger accounts who worry about protecting capital, not about multiplying capital.
So I think this is a great timing for Turn Finance that I think it was yesterday based on our AMA time that Upbit announced that they might be opening up some corporate accounts for the corporates so that they can trade on Upbit as well. It means that more openings up to these institutions that you meet. And also the Korean government is also working on the license for these people to trade more often and more frequently using cryptocurrency. It might change and it is very subjective topic due to the government's affiliation with whoever they work with. But I think this is also another side that many people are very curious about, especially from Korea. On top of that, also I wanted to ask you about like how do you see these regulations about from the Korean government requiring this VASP license when you are ready to do some business, and also like how are you preparing for this kind of license issues? Some of the countries are asking these licenses, even those like fully on-chain companies, but I think this will be some of the things that also Korean users might be interested. And also maybe like something about like Korean market expansion plans in terms of all this like partner onboarding, institution approach, and also market expansion.
Yeah, so I would say the users in terms of TVL on our platform are probably 90% institutions and, whales or high net worth individuals. And, we actually reached out to got connected to some asset managers in Korea that are involved in the crypto space. And yeah, last year it's kind of like, okay, we need regulatory clarity to see where this is going. And, in recent months, they're saying, we're getting more clarity and those conversations are starting to move forward more. And so we're very excited about that. On the one hand, you can say regulation is bad because it makes it difficult for startups to build into a new market. But on the other hand, it also unlocks institutional capital. And so with that clarity, you know what you have to do. If you're willing to do what's right, maybe you have to pay some money for some lawyers. It kind of costs some money. But, if you are able to clear that, then it also becomes a moat. It becomes a way to protect your business in a new market. And so I think it's great that Korea is starting to clarify the rules. And as those become more clear, more institutions will come on board. I think it's a great opportunity for Term to, get in front of these institutions. In the United States, too, we've been talking to a lot of CFI, centralized finance, crypto brokerages, asset managers. You talked to them last year, it's like, oh, we only do CFI, we don't touch the blockchain. And you talk to them this year, the past month, it's like, yeah, we're starting to look at DeFi now. We want to research, want to see what's going on. So we're starting to see a trend across the world where people realize crypto is here to stay. We have to create regulations, and that's going to open up the market much more.
That's amazing. So I think we have gone through all the prepared questions from my side. As a wrap up, do you have any more things do you want to share with the audience or the Korean users specifically?
Yeah, I think we're just really excited that we were able to connect with you guys and have a way to kind of communicate and, present ourselves to the Korean community. Obviously, the Korean community is very well known globally as, the biggest token traders. But, really hearing nowadays that a lot of the community is learning more about DeFi, getting more involved in DeFi. And so I think it'd be great if, I think we'd be a great product for the Korean market, secure, safe, fixed rate yields, very simple, not complicated. And hopefully the community feels the same.
That's amazing. So I hope to see you somewhere in Korea in person and also maybe hosting some events as well. And also more and more people, not only from the institutions, but also the retails enjoying the features and the amazing, cool services and products of finance as soon as possible. Thank you for your time today, Dion, and hope to meet you again sooner than later.
Yeah, let's do it. Next time in KBW, we'll try to make it out there. We'll go drink some soju.
That's amazing. Thank you so much.
All right. Thank you. Take care.
Thank you. Bye.